Thank you. And so this is the agenda for today. Um, so a little bit of housekeeping. We'll talk about the expectations for today. And then we'll talk about tax planning, what it is, concepts and misconceptions of it. We'll talk about the other question, when, and the third question, why. We'll talk about different strategies, capital gains, strategies, real estate. We'll look at long-term goals and tax planning. And we'll also touch on business and complex tax strategies. And then, of course, we'll talk about the solution, pardon the pun, Eureka Wealth Solutions, and then Q&A. So housekeeping, let me start with a little disclaimer. That's a compliance requirement to tell you that today's presentation is for informational purposes only. It does not constitute an investment, legal, or tax advice. And some of the investments that we will be talking about may require you to be an accredited or qualified investor, as the IRS defines it. The full list of disclosure is going to be on the last page in case you have any questions. The last couple of pieces of housekeeping is there is a Q&A. Ideally, I like to keep it until the end. So there is a Q&A box where you can type in your question. If it happens to be about something I'm talking about, I'll try to answer it right away. Otherwise, all the questions at the end. And there is also a chat box. By the way, can everybody hear me okay? Just give me a quick yes or no in the chat, and that'd be great. Okay. You guys can hear me, hopefully. Okay, good. All right. So with that, let's get started. All right, so let's talk about the expectations. So this is not a masterclass. First of all, I'm not qualified to teach one, and also a masterclass in tax planning would probably take multiple days, let alone multiple hours. So you will not be able to do all kinds of complicated tax strategies at the end of this. You will not learn all the possible tax strategies and their implementations. If that was your expectation, I apologize in advance. The plan for today is to give you an overview of various tax strategies. Some of these, even tax professionals, let alone investors, are unaware of, not only not using. I will show you some specific examples and help you understand that potentially there are multiple solutions for almost any situation. And I will help you understand where tax planning fits in your overall financial life. And then, of course, hopefully you'll know where to look for help when you need one. So moving on. So let's address the first question. What is tax planning? So one first order of business, it is not tax preparation. This is probably the biggest misconception, that tax planning is some form of tax preparation. It is absolutely not. It's a separate item. It's related in terms of tax, and don't get me wrong, as Ben Franklin said 250 years ago, taxes are definitely coming, and tax preparation is definitely part of annual life. But tax planning is a different beast. So let me elaborate. The goal of tax planning is to use active strategies to try to reduce your tax bill. It's not necessarily to pay $0 in taxes. This is also a very important distinction that, believe it or not, for a lot of people, tax planning means not paying taxes. That's not the case. So, what are some of those proactive tax reduction strategies? Typically, we talk about 4 different types of strategies. They have to do with large individual transactions. They have to do with investments collectively. They have to do with small businesses and a business owner, and they have to do with estate planning. And we'll touch on all of them as we go through this. So, what's the tax planning process? What does a tax planner actually do? Well, they start with reviewing your prior year taxes, and they identify missed opportunities or mistakes. If you ever heard from your CPA who does your tax preparation, I wish I knew about this before the end of the year. It's very true. The end of the year is the deadline for a number of things, and we'll talk about that in the one section. But that does not mean that certain things can be corrected even afterwards. So there's a way to do amendments depending on the situation, especially if a mistake was made or if certain things were just missed. So that's the first step of a tax planner, to try to identify any kind of money that they can save you retroactively. The next step would be for them to project your income for current and for next year, which sets sort of a baseline for what they can do. And then they will identify and apply usually multiple strategies. And again, usually prior to the year end, although again, there are exceptions from our rule. And then also another task that they will have is to review the tax forms to ensure that they're filed properly to reflect their strategies. Again, this is a very important distinction. They will not be doing the tax preparation. And as a matter of fact, sometimes we've seen some conflicts that arise between the tax preparer CPA and the tax planner CPA, just because a tax preparer may feel threatened by the tax planner because they feel like they're there to look for mistakes they've made or to tell them how to do things, which is not the case. The whole process is a collaboration. It's a different type of skill set. It's a different type of job. But regardless, the final step in the process is for your CPA, or if you're doing taxes on your own, obviously, which in most of these strategies you probably won't be able to. Most programs will not even handle it. But whether it's you or the CPA you're working with, actually record the tax changes and file the tax forms correctly is a critical piece of it, because all the strategies that can be implemented are not going to be very useful if the tax forms are not prepared correctly. So this is always the last step and a necessary step in any tax planning process. All right, so one. Great question. So when do you actually need a tax planner? This is a rule of thumb, so keep that in mind. But typically, if you have capital gains over $100,000, it's probably a good idea to employ a tax planner. Similarly, if you're a business owner with ordinary income of 500 or so, that's also very advisable. If your estate tax is over the exclusion limit, again, this is also a very common situation where a tax planner is probably warranted. In terms of timing, keep in mind, you probably want to talk to a tax planner before any large transactions, before any big financial decisions, and again, before the end of the year. Again, there are exceptions, but this way you cover most of your bases. Again, to reiterate, tax planners are highly qualified, educated, and licensed professionals. They all have the CPA license. A lot of them have JD. Some of them have PhD. They have a different skill set than most CPAs that you deal with when it comes to tax preparation. So their time is valuable, and their experience and their skill set is valuable. So this is probably the most misunderstood part of financial services overall, and I'll explain in the next 45 minutes why. So this is the one, and again, keep in mind, this is a rule of thumb. There are a number of different strategies and situations that make sense even outside of the above guidelines, and I'll touch on some of those as we go through this. And now we get to the why, and the why is actually probably the easiest question to answer. The tax code is very complex. As a matter of fact, there's a general opinion that the US tax code is the single most complicated law ever written by man. Literally no one knows all of it, and most investors, and in fact most financial professionals, know a small portion of it. In addition to that, there are constantly major law changes that affect taxes from every angle: personal, business, and estate taxes. So just in the last 5-6 years, these 4 major pieces of legislation have altered the way that the personal taxes and business and estate are done, and the way that financial planning and estate planning and tax planning is done. And these are, again, just the major ones. There is about 30 different laws passed by the Congress just this year that affect some form of taxes. And most financial professionals would be hard pressed to name at least one. So this is constantly happening. Keeping on track, keeping on top of it is nearly impossible. Understanding the provisions of different laws that may be available and may be expiring at some point, or anticipating future changes in any of the laws, is a whole science and art of a different level. But those things are required also for the tax planning. So you really need a team of professionals to help with that. Obviously, it also depends on the complexity of your financial and tax situation. If chances are, if you only have a W-2 and a handful of deductions, you may not need a tax planner. But in almost any other situation, chances are you're leaving some money on the table. So let's finally take a look at some of the strategies. So let's start with the one that most people are familiar with. When we talk about capital gains, tax loss harvesting is one of the strategies that is probably the most familiar to investors. It basically involves offsetting your capital gains with capital losses. So if you find out that you have a certain number of capital gains, you may find positions where you have paper losses and realize them and offset them against the capital gains that you have. And this way minimize the tax bill for that. It's in fact, it's so common. A lot of the times these days, it's built into various software, whether it's financial planning software or your brokerage software. Most of the robo-advisors now have some way of doing the tax loss harvesting. So why are we even talking about this? Well, the issue is that to do it right, you need to go across all your taxable investments. So if you have, let's say, $10,000 capital gains in one of your accounts, and you run the program and offset the $10,000, but you have $50,000 gain in another account, then you've missed a large opportunity. Or if there's a $50,000 loss in another account, God forbid, then maybe you don't need to do it in this account altogether. So it's important to be able to look at your overall picture. You also need to watch out for the wash sale rule. Basically, when you do sell anything at a loss, and then you do some sort of rebalancing to buy back some of the same securities, if you do it within 30 days of your sale, your deduction from taxes will be disallowed by the wash sale rule. So again, some software may allow you to do that. Most software that does tax loss harvesting will not. And this is something important to keep in mind. It basically wipes out whatever you've done if you forget to do that. And then on top of that, it may not always be beneficial. So just to give you one example, if let's say in the current year your income is down and you expect your income to be higher next year, you may end up being in a lower bracket due to the fact that, let's say, your business had a down year, or maybe you took some time off, or you were laid off, or whatever else, whatever other reason you may have. It may actually be more beneficial for you not to do tax loss harvesting and pay lower taxes on your capital gains this year versus next year that you're expecting your UB to be in a high bracket. So again, it's simple, but there are all these caveats that it's good to keep in mind, and your financial planner and your tax planner can help you make those decisions better. Moving on. So I'll give you one more example in capital gains. And this will be probably the quickest explanation of opportunity zones if you've ever heard one, just because we don't have a lot of time. But what is an opportunity zone? This is a designation that was created by the Tax Cuts and Jobs Act back in 2017. And yet to this day, a lot of investors are not familiar with it, and many financial advisors are struggling with the concept. The idea in a nutshell was for states to be able to define certain zones, geographical areas within their states where there is a challenge in real estate development for a number of reasons, whether it's a poor neighborhood or it's been underdeveloped for any other reasons. And so the idea was to give investors an incentive to do real estate development there, and that incentive was in form of tax benefits, which I will talk about in just a second. So overall, there's nearly 9,000 opportunity zones that have been designated across the United States. Every major metropolitan area has multiple of these opportunity zones. And there's plenty of opportunity to make investments. And these, again, they're not limited to things like schools and low-income housing, which is potentially one of the misconceptions out there. They have luxury hotels in downtown Miami that's part of opportunity zones, for example. So the point is that any capital gain, pretty much from everything, just important to remember that dividends are not allowed to do that, but whether it's capital gains from sale of securities or business or real estate and a number of other potential capital gain items are eligible to be rolled into the opportunity zone. And you have 180 days after you realize gains to do that. So that's actually one of the exceptions from the end of year rule. And there are three separate tax advantages for this. First, anything that you roll over will get deferred on the capital gains taxes until you sell until December 31st, 2026, which, by the way, is very likely to be extended by Congress. Of course, it will depend on the political and economic situation. I suspect around the fall or maybe even December of 26, but the industry is expecting this date to be extended. The second advantage is the step-up basis. So if you hold it for 5 years or longer, you get 10% tax reduction on the gains. And then the last one is the capital gains exclusion. So if you hold it for 10 years, which obviously is not going to happen until 26, but in theory could happen if it's extended. And then any gain in the actual investments in the opportunity zones is tax-free. So these are three very powerful tax advantages. And of course, this investment, as any real estate or any investment for that matter, comes with certain risks. So you may want to look at the actual investment that is happening in the opportunity zone. But at this point, there are literally hundreds of funds. A lot of them look similar to hedge funds in the way that they run, in the way that their fees are concerned. There's also some liquidity risk to remember, but overall, there is actually one publicly traded opportunity zone today, but overall, this strategy allows to potentially at least defer significant capital gains for an extended period of time, and the other two tax benefits that go with it. All right. Real estate. We'll talk about that for the next few minutes. So in real estate, there are several other strategies. We'll focus on two. One of them is the 1031 exchange that people may be familiar with. The Section 1031 basically allows an investor to defer the payment of capital gains taxes when they sell a real estate property and simultaneously make a purchase of the like kind real estate, which loosely is defined as, similar type. So the way that this works, there are several caveats, of course. And by the way, when I talk about real estate here, I'm not talking about your primary real estate residence. There are definitely some strategies that are involved in terms of getting mortgage, how much mortgage, potentially refinancing the mortgage, potentially using home equity loans, depending on your situation. But this is not what we're talking about here. We're talking about investment real estate. So whether this is real estate for residential rent or for multifamily housing, it could be vacation property, it could be campus housing, it could be industrial, warehouse, commercial property, medical office, parking lot, car wash, you name it. All of that fits under this description. So if you are at some point selling your property and you're looking to minimize your taxes, you're looking for a 1031 exchange where you have a replacement property, the new property. The rule stipulates that the property must be greater of value than the one that you sold. You also must invest all of the proceeds into it. Anything that's uninvested from the amount that you sold is called a boot and is subject to capital gains tax. And then also the debt on the replacement property, so if it's under any kind of mortgage, must be greater than or equal to the debt of the property that you sold. So these stipulations exist. In addition to that, one important item is that there should be a qualified intermediary, which is basically an entity that knows what they're doing, that participates in the transaction of the 1031 exchange. And before we look at the actual timeline of the 1031 exchange transaction, it's also good to know that there's such a thing as Delaware Statutory Trust, DST. which is a passive investment vehicle that allows multiple investors to essentially own fractional shares in a single property or portfolio of properties that are eligible for 1031 exchange. So DST is similar in many ways to LLC, which is, but it's specifically defined for real estate, and it also has certain provisions on depreciation, which also helps. And the idea is that a DST would probably be managed by a professional real estate manager. So if you have a rental property which you decided to sell, DST allows you to purchase potentially a share of another real estate or a portfolio of other real estates where you are going to be passive. In other words, you don't have to worry about the tenant calling you with, problems with the bathroom or anything of the sort. The management company will be taking care of it, and yet you're still able to defer any capital gains by utilizing the 1031 exchange. So that becomes a very powerful tool for real estate investors. Moving on, this is a more advanced real estate strategy. Again, I'm showing only some of the top strategies out there, but this one is probably the most overlooked. So what is that? Any real estate purchase, if let's say you buy a building, or whether you're a business owner or you're a real estate investor, you're allowed to write off depreciation by the IRC code. Depreciation is obviously just the accounting method that allows you to allocate costs of your assets over the useful life. So typically, in case of real estate, you are allowed to use straight line, which is just as it sounds. You have the total number of years that is also usually, in case of real estate, defined by the IRS, and then you can divide it by your total value of your asset by the number of years, which is what most CPAs would do. So here's an example. For commercial buildings, it's 39 years. For residential buildings, it's 27.5 years. However, what is the cost segregation? You may realize that a building, when you buy it, it includes a number of additional parts, things like machinery and equipment, electric wiring, roofing, flooring, garages, parking lots, and potentially a bunch of other parts that can be separated from the overall building. And those items actually have much shorter useful life. So if you typically would employ an engineer to be able to identify those and separate those out. And once you break those out, what we in our tax planning team can typically do is depreciate anywhere between 25 and 60% of a given building in the first 5 years. So think about it this way. I don't have a specific numbers example, but if you did buy a commercial building, let's say for your business, or for land for that matter, typically in the first 5 years, you can only depreciate something around 12% of that building by using straight line depreciation alone. By using cost segregation, you're probably looking at 5 times that. Which is obviously huge for any owner. And as I mentioned, this is one of the most overlooked tax strategies, and it does require a tax planning professional to be able to do this for you. All right, so we're going to move on to long-term goals and looking at tax planning from that perspective. This is where the long-term when we talk about long-term goals, this is where financial planning and tax planning and estate planning kind of all meet together. Um, and it really depends on what your goals are. But it usually the first line of offense would be to use tax advantage accounts. So depending on your goals, such as retirement planning, college planning, estate planning, health planning. So in some families, you may have known health issues, but even if you don't, there's always a question of planning for your health care today and tomorrow, maybe for your kids or your grandkids or for your parents or grandparents. Um, then, of course, there's goals of large purchases, typically homes, or investment real estate, or even things like cars, and of course, charity donations that are important to some people more than others. But goals, especially for the future, require some planning for that. So the tax advantage accounts um, that can be used, I'm sure look familiar. So the 401ks and its siblings are probably the most commonly used. There's a solo 401k, which is used for business owners. And by the way, we help business owners also set up and run their 401ks. Then there's IRAs. 529 plan is the most common vehicle for savings for college. And we also teach, by the way, a webinar on college planning because that's one of the things that we specialize in as well. But it's not the only way. Coverdale, for example, is one of the less known ones. The uniform gift to minors, those are potentially important vehicles to transfer your wealth to your children. HSA is the health savings accounts that could be used for health planning, and donor advised funds. Again, there are specialized vehicles for charity donations that could be useful for that. We obviously don't have time to go through all of this, and you're probably familiar with a lot of them. But there are a lot of things that even financial professionals may not know about this. Like, for example, the solo 401k designed for small business owners allows business owners to contribute as both the employer and as an employee to their 401k. And so if the regular corporate 401k limit, contribution limit this year, I believe, is $22,500. The solo 401k has a total of $66,000 as a maximum contribution, which for a lot of individual small business owners could make a lot of sense. There's a lot of new legislation around the IRAs and Roth IRAs. The limits are also being raised because of inflation, so these are good things to keep in mind. The 529 plans, there are also a number of different versions and a number of caveats. So I'm not going to go through all of this, but I will talk about generally long-term tax considerations. A lot of these strategies will depend on your current and future income projections, and of course your current and future spending projections, which may be even harder. The assumptions around the future tax rate, which is always a hard thing to predict, and even harder thing to predict is the rate of return. And then, of course, the one that nobody wants to predict is the longevity assumptions. But based on some of these assumptions and projections, you may be able to devise some really powerful tax saving strategies. So I will talk briefly about one of the common techniques, the Roth IRA conversion, and then another technique on these accounts. So the difference between the IRA and the Roth IRA is that the main difference is that with the IRA, you may be able to contribute to it with the tax deduction for the current year, depending on your income. But then when you take money out, you have to pay taxes from any pre-tax portion that you've contributed, plus any money that you've made. The Roth IRA can only be contributed on the post-tax basis, but the idea is that once you take money out, it's tax-free, both the amount that you contributed and any earnings on the account, and both grow tax-deferred. And I'm sure I don't need to explain that the tax-deferred portion is the huge draw, because the power of compounding is very powerful. So depending on your situation, you may or may not be able to actually contribute to a Roth IRA. If you're over a certain income, you cannot contribute to it directly. And if you're over a certain income level, any contribution to a traditional IRA may not be deductible, or maybe partially deductible. But the idea of the conversion comes so the IRS allows you to do this conversion, and the three benefits of it is that obviously in retirement you will enjoy tax-free withdrawals. So if you're expecting to be in a lot lower tax bracket in your retirement, which most people will be, it could make sense. It could also make sense to watch your money grow tax-free for longer. That refers to the requirement of the traditional IRA to have a required minimum distribution that starts now at age 73. So the graph above is slightly dated. That's a relatively recent change. But with the Roth IRA, you don't have the required minimum distribution requirement. And then on top of that, you can leave a tax-free inheritance to your heirs. So what happens when you pass, the traditional IRA has a requirement as an inherited IRA to be distributed within 10 years. So that's an onus on your heirs to deal with it and deal with the subsequent tax consequences. With Roth IRA, again, you don't have that. Your heirs just inherited tax-free, which is another very powerful tool. Of course, the issue with that conversion is that you have to pay taxes now. So that's a consideration for you and your financial tax planner of any given year, whether it makes sense based on the performance that year to some degree and your tax level at that year, and where you are in terms of changes in your future tax rates. So moving on, one other thing I wanted to mention about Roth IRA conversion. If you're our client, you get for a number of financial decisions, you may get one of these wonderful cheat sheets of flow charts that you could appreciate. Again, this is a guideline. This is not for all cases, but it gives you an idea of what to look at. And this is a particular one for your Roth IRA conversion to figure out whether or not you actually end up with any kind of penalties, which is obviously also a consideration. Typically, if you do it right, you should not, but there are certain circumstances where that's the case. And then the other one that I wanted to talk about is the backdoor Roth IRA. So as I mentioned, the idea is that if you're above, if your income is above a certain level, you cannot contribute to Roth IRA directly. But you can, using the conversion that I just described before, contribute to IRA on a post-tax basis and then immediately convert it to Roth. This way you can bypass income limits. And in addition to that, the tax that you owe from it is derived by using a pro rata of the portion of all of your IRAs that you're converting from traditional IRA to Roth IRA, And if you don't have any other IRAs, by doing this process that I just described, you pay no taxes and you effectively were able to contribute to the Roth IRA, even though your income limit does not allow you to do it directly. So this is a technique that I have personally been using for myself and my wife and for a number of clients. And it's still a valid loophole that has not been closed by the Congress and may be closed at any given year, but it still exists today. All right, so we are running out of time, so I will just quickly mention some of these business and complex strategies. I can easily spend, well, at least an hour just to cover this one page. And these are, again, different types based on, so the name in blue indicates this is for a business owner. The brown ones are for investing, and the purple ones are for estate planning types. And again, these are still only the tip of the iceberg of what's out there in terms of potential tax strategies. So moving on to us, just a quick introduction. Well, for those who don't know us, we're fiduciary, we're fee-only RIA. We actually specialize in thematic and impact investing that I can talk about separately, and in fact, I will as part of a webinar in October. And we do very personalized financial planning and tax planning and estate planning, depending on your needs. We also manage held away accounts. So things like corporate 401ks and 529 plans that cannot be usually moved to a financial advisor account, but we're able to do that without taking custody of them. We also have access to alternative investments for qualified investors that, sometimes you don't have access to those opportunities directly, or at the very least will provide significant discount in both potentially pricing as well as substantially lower minimums to use for those alternative investments. We also help small businesses with 401k plans set up and management, and we also have partners that help with funding and franchising opportunities for small businesses as well as for high net worth individuals. We also donate 2% of our fees to the charity of Investors' Choice, which is how we get started with charity. But if that's important to you, that's a separate conversation, obviously. And I also wanted to mention that we are a proud associate partner of New York City Football Club. So how much? I guess there's one other question that I haven't answered. This is generally the structure of our fees. We have 4 different plans based on your needs. The starter is just a low-touch, digital-only investing option. The Plus account adds advice interactions and many a la carte services. So we can do specific financial planning, for example, projects, or access to alternative investments or the estate planning. Power Plan includes full financial planning. So everything that deals with financial planning. There are no separate fees for additional projects. And Super is the one that includes full tax planning that we were just talking about. These fees are tiered, so that means just like tax brackets, you are getting fees on the lower portion at a higher rate and then on the higher portion at a lower rate. And the way that this is designed, as you can see for Power and Super, even though there are technically no minimums, the way that these are structured is that we assume the fees based on a minimum of about $100,000 in case of Power Plan and about $500,000 based on the Super Plan. You can bring less money, but the minimum fee that we charge will be based on those numbers. So how does it actually work? Where does tax planning fit in with everything that you're doing? Well, so you would have a consultation with Eureka and our tax planning team. And then you will get presented with tax saving options. This will be an analysis of potential savings, costs, audit risk, which is also always a consideration, and potentially other considerations depending on the situation. You may choose one or several. You may choose none if you don't like any of them for some reason. But if you choose one or several, the cost of the implementation will also be presented to you, and it will be substantially lower than the savings. So the implementation costs will actually go to the vendor that helps with the implementation. There is no fee to Eureka Tax Planner. So let me repeat that. There's no fee. There's no fee that you would pay to Eureka or the tax planner. Your only commitment is for that super plan that I just described above. So to give you an example, let's say you go through this exercise, your first tax strategy, is as described above. You save 50,000 and it costs you 10,000. Second strategy saves 30,000, costs 5,000. And then you sign up with a super plan with the minimum of 500,000 with assets under management. Your total tax savings are 80,000. And again, this is an example. The actual situation will obviously vary, but it's probably a fairly typical example. And your total costs are a little over 21,000. So you're saving nearly $60,000, and other services such as managing your investments and full financial planning and a lot more are included on top of that, essentially for free. So hopefully this is the case as a no-brainer, but feel free to ask me questions about any of that. So in conclusion, please don't call us. That's right. Don't call us if saving on taxes is not for you. If you don't identify with any of these issues that we've talked about, or you just don't like saving on taxes and you like to pay as much as the IRS tells you in most cases. Also, don't call us if you can do this on your own. I mean, I don't know anyone without very specialized skills who can do it on your own. Or if you can find the service cheaper or better elsewhere. Otherwise, you all out of excuses. Go to our website, take a look. When you're ready, click on that big orange button, schedule your free consultation. And the timing is also right. We're just about entering Q4. And the fourth quarter is very important. As a matter of fact, our tax planners are just like Amazon. They make 80% of their sales in fourth quarter. So this is the time to talk to us and to our tax planning team. A couple of words about me. I've been around for a while. I've been running the Eureka Wealth Solutions for almost 9 years now. And you can reach me directly at this email. And this is the disclosure I promised, and time for Q&A. Any questions, Frank? Well, I'm glad you enjoyed it. I guess you were the last one at the end here. Yeah, so let me know. Feel free to email me directly, or anything else that's on your mind. Other than that, thank you very much for joining us, and have a nice day.